one thing you can say about Friday's downgrade by S&P, many saw it coming. Robert Kaplan is among them. He's the former vice chairman of Goldman Sachs. And in an op-ed last month, he predicted America would lose its AAA credit rating and pointed to dysfunction in Washington as a probable cause. Rob is now a professor at the Harvard Business School. He joins Sara and me right here. Rob, before we get to the dysfunction in Washington, because that's a key subject for consideration right now, given your experience at Goldman Sachs, what's going on Wall Street right now?
Well, you're going to have some confusing things today. First of all, Treasuries, we talked over the weekend, are likely not to show much impact.
No, they're rallying like crazy.
And the reason is there's two conflicting things. There's the downgrade, but there's a flight to quality, and we're still, you'd have to say, the best house and maybe in not such a great neighborhood. And so it doesn't surprise me you're going to see people flow to Treasuries. Stock market, on the other hand, is continuing its revaluation based on expectations of lower growth. It'll find its level, but it may take a number of days.
So take us inside the fixed income department at a firm like Goldman, at a firm like Merrill Morgan Stanley. Is it a kind of a panic situation right now, or is it fairly under control?
I think everybody, all of us, are just trying to assess what this means. A number of mutual funds and bond firms are trying to read their contracts and figure out technically, as you've reported, who actually can own split-rated securities. But everybody will get through that in the next, they did it over the weekend, they'll get through it in the next few days, and I think this will probably settle down. The truth is, even before the downgrade, the problem in the United States was the same. We had slowing growth and we had to deleverage. That's still our challenge today. And, you know, looking forward, it's still the opportunity for leaders. This is a leadership moment. And I hope this finger pointing over the weekend, I know it's an election season, but that is not the right first reaction. Blaming S&P, you can say what you want about them. That's not the right reaction. We need to focus on what to do now. And I think that leadership would calm the markets more than anything that could be done.
You bring up a good point about fixed income. 1 out of 3 major rating agencies has downgraded the U.S. So does that mean that funds have to sell?
Some do, and literally, this is a technical issue that most of us haven't had to think about in long time, and so I think most firms are actually going back and rereading the documents. So I just know what I read reported. Some do, maybe less than people think, and I think you'll see the Treasury market, for the moment, hold up pretty well.
Rob, you mentioned the war of words, effectively, between the White House and the Treasury Department and Standard & Poor's. You say it's the wrong thing to do to fight back against S&P, but did S&P do the right thing cutting the credit rating when it did on Friday after it emerged that their math was wrong?
Well, you got to remember, they put the United States on on negative watch. I believe it was in April. Mm-hmm. So if I was advising a company, and I've worked on a lot of sovereign ratings over the years advising countries, if S&P puts you on negative watch, you better be prepared for anything. So unfortunately, it was probably a matter of time. Once the grand bargain of $4 trillion didn't happen, I think this was a matter of time. I would actually argue in January of this year, when Simpson-Bowles came back with their recommendation in a presidential commission, and Obama and the administration did not endorse at least the framework, I would argue we were maybe on our way here then, unfortunately. It's still not too late, though. And I teach leadership at Harvard. I'm more focused on what they do now. It's still time. I would go back to the Simpson-Bowles framework. I hope it's not. I don't think it's too late. And they've got to look at everything. But the challenge now is not just how to deleverage, it's how to grow the economy. And I think you're going to see some announcements and more focus on that now in the next number of weeks.
That's very much a medium-term thing. I want to bring you back to one comment you made at the beginning, trying to figure out how this plays out on Wall Street. Is there the possibility of a Lehman Brothers-like situation, unforeseen consequences, something akin to the Reserve Primary Fund breaking the buck over the next couple of days?
From what I can tell, I don't think so. I think the European banking situation and the Greece situation is more of a banking problem in Europe, which could have some implications. But I also think all the regulators are quite well prepared for this. I think this is really more about growth and slowing growth and how do the markets deal with it.
Well, Rob, is this the sort of game changer that changes a major investment bank's? I mean, I would expect that it would change the major investment bank's long-term strategy when it comes to investing in the United States versus other countries.
Let's put it this way. The price targets for the S&P, my guess is, are going to change in the next number of days.
Rob, we have to wrap it there. Thanks so much for being here. Rob Kaplan, former vice chairman at Goldman Sachs, now a professor of management at the Harvard Business School.